and had a comment about the Fed, and let's talk about the figure that moves the Fed most. Jobs in America, it's the first Friday of the month, coming soon. It's the king of foreign exchange indicators, moves markets most. Had its bigger days in the past, but still is a key indicator. U.S. non-farm payrolls on Friday, 12:30 GMT. Let's provide a bit of background. So the last report, the report for the month of February, came out early in March. It came just before the March hike. It came out, remember, on March 10th. All right, 5 days before the rate decision. Maybe the Fed officials already had the figure because it was released that late because of, well, February's a short month. Anyway, 235,000 jobs gained. Excellent news. And wages rose 2.8% year over year. Also great news. Unfortunately, in that specific Friday, markets focused a bit on the miss or on the month over month. That month over month miss was accompanied by an upwards revision for the previous month. All in all, a job market is ahead of current growth, is growing very nicely. Jobs are rising. That means the U.S. economy is not only our just a second. It's okay. Sorry for that interruption. All in all, the U.S. jobs market is looking good. Not only good enough to we're seeing good gains in jobs, but employers are willing to pay more money to employees, so it's good news. And what about the Fed? Okay, the next Fed decision is in May. No press conference and no new forecast. No chance of rate hike in May. They'll tell us each time that every meeting is live. Well, they need to justify their pay, but nobody expects them to move. Therefore, the figures will accumulate. It's not sort of the final figure, the yes or no for a rate hike. It will accumulate together with the next jobs reports, together with lots of other data points, okay? But of course, it will move markets on Friday. And it still remains the king. All right, NFP, what's on the cards? So according to expectations, 176,000 jobs are expected to be gained in March, but these expectations will further change today with the ADP and the ISM non-manufacturing PMI. Last time they didn't move things too much, so anyway, it'll be in the vicinity of those amount of job gains and wage gains. 0.2 month over month, more of the same, around 2.7, 2.8 year over year. All in all, I see these expectations as relatively modest, sort of a bit under recent good data, and but well, maybe it is realistic because last time we really had an excellent report. What does it mean, the non-farm payrolls for the dollar? This time it's really straightforward. 1.1 plus 1 is 2. Okay. Wages are still important, just a bit less important than last time. Last time they were sort of really the key. So I see it, well, no specific bias against the dollar or for the dollar. If we have job gains and wages coming out ahead of expectations, beating, dollar should rise. If they miss, the dollar will likely fall. If it's a mixed outcome, wages should still have the upper hand eventually. Okay, more than the change in jobs. But all in all, it's straightforward. Last time it was asymmetrical. Last time we needed a really terrible figure to push the dollar lower. We didn't get that, and everything was okay. Now this time it's very symmetrical, very straightforward. So less of a focus because we're not just before a rate hike, a big rate decision, but I think maybe this calmer atmosphere should provide better opportunities to trade it. Okay.